Welcome to Cambridge House Live. I'm Vanessa Collette at the World Resource Investment Conference. I'm joined by David Franklin, market strategist at Sprott Asset Management. Welcome, David. Great to have you here with us.
Thank you for having me.
David, you're giving a talk later at 4:30. What are you going to be speaking about primarily?
Well, the title of my keynote presentation will be Gold Bars, Bullets, and Squid, the economics of shortages. So we're going to go through some of the impact that quantitative easing has had on many different markets, from precious metals to bonds to the market for squid in Japan.
So how does it all tie into squid?
Well, what all of those markets show is some form of shortage. And so today we see a shortage of gold bars available for sale, as demonstrated by the Shanghai premiums. We show there's a shortage of ammunition in the United States, where no amount of money can buy more ammunition, and
they can't just 3D print some more ammunition.
Guns they can, ammunition they can't. And what Japan has done with their quantitative easing program has devalued the yen by so much, it's uneconomic for squid fishermen to go out and catch squid, because the fuel prices have come up so fast. So the connection between them all is that they're in some form of shortage. And so I'm going to try and show that there's some shortages in other commodity markets that are forming today, where I think investors would do well to invest in.
So when you talk about the shortage in physical bars, is that because of the disconnect between the gold price and the actual physical amount of gold available for people to purchase?
Well, there's two reasons that are driving the shortage. One is that the amount of gold that's being shipped over to China is far short of what current demand is. The other aspect of demand is it's mostly retail, so they're looking for smaller quantities. So refiners can't produce these smaller bars and coins fast enough. And in fact, it appears that there's a shortage of the metal for acquisition over there. So, those are all caused by these different price signals, these erroneous price signals that they're getting in the market. And I think the cause is quantitative easing.
So the money printing that you mentioned in Japan, is that related to what happened, the plunge in the Nikkei last week?
Well, if you take a few steps back, the first government, or the new government in Japan, came out and said, we're going to beat deflation and we're going to bring Japan, we're going to create inflation. So their goal was to create 2% inflation, and to do that they were going to print double their money supply. Now this is unprecedented in the world. This is a huge macroeconomic experiment, and no one's really quite sure how it's going to work out. So in relative terms, they're printing just about as much as the U.S. is on a monthly basis, but their economy is 3 times smaller. So, or one-third smaller. So this is unprecedented. The world's never seen this before. So they said they're going to double the monetary base in 2 years, and we've seen all kinds of dislocations in the market. So the Nikkei is up 65% in the last 6 months. We've seen the yen be devalued by 25%. And what are the implications of that? No one can know for sure. We've seen dislocations in the bond market, where they've had to cease trading in Japanese bonds 3-4 times a session because the market's becoming disorderly. So it is a real, the ultimate implications are unknown, but it's causing some big dislocations in the market.
So what is the source of all these dislocations and stresses on the global economy?
Well, I mean, there's a number of reasons. As we look at Sprott, we think it's related to negative real interest rates and excessive quantitative easing.
So it's all the manipulation.
Yeah, it's all the manipulation, and sometimes that seems like a bad word, but when Japan is going to go out and buy 70% of the bonds that they issued this year, the Bank of Japan is going to buy 70%. You can't have that much market activity without having. You're buying 70% of the supply, so that's going to manipulate the market in one way or the other.
So Ben Bernanke's been talking about tapering quantitative easing. Is that something that you think he's preparing the public for, or do you think they can actually stop printing money?
Well, I think what's going on right now is the Fed is a bit of a madhouse. You have a number of the members of the governing council suggesting they're going to cut it. You have some saying we're not going to cut it, we need more. You have some saying we're going to increase it a little bit, others saying we're going to decrease it a little bit, and they're really confusing the market. I think my personal opinion is that they can't ever stop, and so these are just window dressing around these monthly meetings. But as the Fed has such a huge influence in the market is almost hanging on every word that the Fed is saying. So if we pull a little back, the market comes back. If we add a little more, the market goes up. And so we've really dislocated from the underlying economics in the economy in the world. And so we're pricing stocks based on Fed minutes, which is really a lot different than the way it used to be.
So what do you think investors should be doing right now with the gold and silver price pullbacks and even platinum that we've seen also?
Well, I think as you look at the price action in gold and silver, a lot of it is being driven by the paper market. And depending on, I've read a number of studies and a number of estimates from people suggest there's as much as 100 paper ounces for every real ounce in the gold market. As much as 50 ounces of paper for every real ounce of silver. So when you see these dislocations that are happening in the market, we see the paper market is setting the price for the physical market. And so what I think investors should be doing when we see these huge pullbacks is buying some physical silver or physical gold every time we get these big pullbacks. And I think we're seeing that all around the world. These price pullbacks are painful, but I think that's an opportunity to switch from paper gold into real gold.
When you look around this conference, are you seeing any opportunities or any companies standing out for you?
We've been out here many years, and there's lots of opportunities out here in the market. I notice there's a sort of a glum mood around the market here.
There's gloom and doom.
Yeah, a little bit gloom and doom, but there's lots of opportunities in the resource market. One of the ones that we've been talking about is platinum and palladium. Think about the palladium market was in a 1 million ounce deficit in an 8 million ounce market. So we are short 1 million ounces of palladium last year. We're going to be short 1 million ounces of palladium next year. And I think that represents a huge opportunity for investors to invest in a precious metal that's experiencing a deficit, that's experiencing growing demand, and there is no supply to meet that deficit. So our expectation is the price has to rise.
Do you have any top picks or any favorites right now?
Well, in the platinum palladium space, one of our top picks is Prophecy Platinum. We own that in several of our funds, and they are an explorer in Canada. They're a long way from production, but we think they've got a good shot at it. And Ivanplatz is another platinum and palladium company that we favor. And again, they have the opportunity to redefine the platinum space, but we're 10 years away from seeing any of that production. So these shortages that we're seeing today in the marketplace won't be covered by either of these companies. So that's where I think the opportunity for investors is to buy the physical metal.
What about with the larger companies, Stillwater and Vale, who are producing in North America?
We like to stick to companies that have almost as pure a focus on platinum and palladium as we can. Vale is, of course, a huge company. They do produce platinum and palladium, but they also have a number of other businesses that we're bullish or bearish on. And Stillwater is going through almost a reorg at the board level, and I think we're going to sit back and wait and see how that plays out. So there's very few opportunities for investors beyond the real metal, which makes it simple for people to participate.
Absolutely, great. Well, thank you so much for joining us today, David. It was a pleasure, and we look forward to having you back again soon.
Great, thanks for having me.